Hey everyone, and welcome back to the channel. Are you ready to take your trading to the next level? Today we're diving deep into the world of moving averages, a tool that's both powerful and surprisingly simple. We'll cut through the noise and focus on the strategies that actually work. If you're new here, make sure you hit that subscribe button and the notification bell so you don't miss out on our future videos. So what exactly is a moving average? At its core, it's a trend-following indicator that smooths out price data to help us see the underlying direction. Think of it like a gentle filter for market noise. It gets rid of the whipsaws and price fluctuations, giving you a clearer picture of where the market might be heading. In this video, we'll be primarily working with the exponential moving average, EMA, and we'll mainly be using the 50-period EMA. Don't get too caught up in the technicals. We're going to keep it simple and practical. Now, before we dive into strategies, here's the golden rule. Moving averages are not standalone magic tools. They should always be used in conjunction with price action analysis and other confirming tools. We never rely solely on a moving average for trade entry. Think of it as a support system, not the main act. Also, a big mistake is to use too many moving averages. This can clutter your charts and cause lagging signals. In this video, we will focus on the 50 EMA, but we'll also touch on the 20 EMA and 200 EMA. Lastly, using lower time frames will get you in a lot of chop and fake outs. Using higher time frames is best for trend clarity. The 50 EMA can provide insights into trend direction. When the 50 EMA is above the price, that's usually a sign of a potential downtrend or bearish sentiment. Conversely, if the price is above the 50 EMA, that suggests an uptrend or bullish sentiment. When the 50 EMA is fluctuating through the price action with no clear direction, you are in a ranging market. A break through the 50 EMA can also signal a potential trend reversal. This is not a guarantee, but a cue to start paying attention. Finally, the 50 EMA can act as a dynamic support or resistance level. Price will often react around this level and can be a place to find confluent entries. Let's start with trend trading. Let's say you're on the daily time frame and have identified a clear uptrend with higher highs and higher lows. You've also identified a key support level and notice the 50 EMA also sits right there. This makes this a high confluent point. As price retraces down to this level, we wait for price action confirmation with candlestick wicks rejecting and forming indecision candles. This is not enough. We put a trend line on top of this short-term downtrend. We wait for a break of this trend line to confirm the uptrend can continue. For a tighter entry, you can go to the 4H time frame. You'll get a more granular look and can potentially enter at the trend line break here. It's essential to have these layers of confirmation before entering. You need both long and short traders to react for momentum. Now let's look at reversal trading using the 50 EMA. Imagine that price is in an uptrend, breaks through a trend line, and then breaks through the 50 EMA. This is your first sign of a potential reversal. Then, the price makes a lower low. You have found a key resistance level that acted as both support and resistance in the past. We now have a high confluent access point. Price comes up to this point and rejects with a long wick candle. This is not enough. We put a tight trend line on the short-term pullback and go down to the 4H time frame. Once this trend line breaks, you have confirmed the downtrend. Let's kick it up a notch for those more aggressive traders. Here's where we use the 50 EMA on intraday timeframes. On the daily chart, we have a long-term trend line broken with a candle close above. This indicates a short-term bullish bias. Instead of waiting for the retest of a previous key level of support, we can get in earlier using this strategy. Looking at the 4H time frame, we see a current uptrend along with a short-term support level, a trend line from 2 points, and the 50 EMA all coming together at an access point. We are waiting for our price action confirmations. We put a trend line on the short-term pullback and wait for the break to enter. You see how all these things line up, creating a high probability trade setup? Now let's move on to the classic moving average crossover. We will use the 20 EMA and 50 EMA for this. It's a simple strategy, but it has to be done right. If the 20 EMA crosses above the 50 EMA, you look for a buy, and if the 20 EMA crosses below the 50 EMA, you look for a sell. But the big mistake is to enter immediately on the cross. This only works if the market is trending and can create many false signals in a ranging market. So what we need to do is first find a market that historically reacts to the moving average crossover on the daily time frame. If it's not consistent, we do not trade it. Now for exiting, we do not wait for the crossback. It is better to use an ATR trailing stop loss for better risk management. We can also treat the 50 EMA as support and resistance. When price action reacts at the 50 EMA combined with an overbought stochastic at a resistance, you have a sell opportunity. You have confirmed that the 50 EMA is acting as a resistance. You can also treat it as a support. When price action reacts at the 50 EMA combined with an oversold stochastic, this will provide a buy opportunity. Now let's talk about a secret weapon that can seriously boost your trading success, the 200 exponential moving average. The 200 EMA is a very powerful and widely used trend filter that can dramatically increase your winning percentage regardless of what strategy you're using. The rule is simple. If the current price action is above the 200 EMA, you should only consider long or buy positions. If the price is below the 200 EMA, you should only look for shorts or sell positions. This helps you stay on the right side of the major trend and avoid getting caught on the wrong side of the market. Let's take an example. Suppose you have a buy signal generated from another strategy like the super trend, and the price action is currently trading above the 200 EMA. That's a buy signal with more confluence and a trade that you should strongly consider. However, if that same super trend buy signal comes up, but the price is below the 200 EMA, you should disregard that signal as the likelihood of success has decreased. The same works for sell signals. Confirm it with the 200 EMA first. By using the 200 EMA as a trend filter like this, you're significantly increasing your probability of success while also filtering out many lower probability signals that might take you into a losing position. So there you have it, a comprehensive look into using the moving averages and specifically the 50 EMA with practical strategies you can start using today. Trading is not about trying to find that one perfect entry. It's about having a methodical and consistent approach. Remember, trading is a game of probabilities, not guarantees, so you need to understand and manage your risk effectively. You also need to patiently wait for all of your rules and confluent points to line up before entering a trade, as rushing into a trade could lead to you losing money. If you want to explore these concepts further or dive into more specific trading strategies, make sure you have subscribed to our channel. We will teach you everything you need in order to become a professional trader. Don't forget to hit that like button if you found this video helpful, drop your questions, and share your own trading insights in the comments below. Thank you so much for watching, and I'll see you in the next video.